Silver is trading at $82 right now. Let that sink in. Gapped to $97 Monday morning. Hit $90. Now sitting at $82. War escalating across 15 countries. Chinese demand setting records. Oil infrastructure collapsing. And silver just lost $15 in 48 hours. That's not fundamentals. That's forced liquidation. And if you understand who benefits when the crowd gets flushed, you understand exactly what's happening. Roxanne here. Let's break it down. Roxanne here, starting with where we are right now because the numbers matter. Silver spot trading at $84.81 per ounce as of Tuesday, March 3rd. That's down 5.8% from $90 Monday. COMEX futures sitting at $82. Spot above futures. That's backwardation. Physical silver trading at a premium to paper. That doesn't happen unless physical is tight. Here's the timeline. Silver closed Friday at $93. Physical-backed crypto markets ran all weekend. Kinesis near $100, Hyperliquid at $96. Monday morning, silver gapped to $97. Gold punched above $5,400. For about 2 hours, it looked like the breakout everyone expected. Then, the hammer dropped. Right before New York opened, silver got slammed. $97 to $90 by mid-morning. Then $90 to $84 by end of day Tuesday. A $13 drop from the gap high. Roughly 13.4% in under 36 hours. That's not profit-taking. That's positioning warfare. Now let me explain the mechanics, because this is where understanding beats emotion. CME Group raised margin requirements on silver futures effective late December. Initial margin for March 2026 contracts jumped to $25,000 per contract, up from $22,000. That's a 14% increase. Then another adjustment came January 30th. Silver margin parameters moved from 11% to 15%. Higher risk tiers increased even more. When exchanges increase margin, traders without capital are forced to close or face automatic liquidation. This isn't theory. This is documented mechanism. FX leaders reported the 200-period moving average at $87.69 is the line in the sand. If silver drops below it, the next target is $82 to $84.90, where institutional buyers are expected to step in. Guess where we are right now? $82 to $85, right in that zone. The forced liquidation took silver exactly to the level where the algos predicted institutional accumulation would start. That's not coincidence, that's execution. Now here's the question nobody's asking loudly enough. Who holds the largest position in SLV right now? Jane Street. $1.3 billion position. This isn't about whether Jane Street is bullish or bearish on silver as an asset class. This is about control and edge extraction. When institutional quants accumulate a position that size, they're not passive holders waiting for the fundamental thesis to play out over quarters. They're there to extract profit from volatility. And their edge comes from your reaction. The algo is built for this exact sequence. Pump hard enough to pull retail in at resistance. Create maximum bullish sentiment. Then dump fast enough to shake them out at support. Liquidate the weak hands, accumulate lower. Repeat. Pull up an hourly chart. FX Leaders identifies must-hold support at $87.69 on the 200-period moving average. We lost that. Next level is $82 to $84.90. We're there now. If this level breaks, the next stop is lower. But here's what matters. Shanghai spot silver sitting at $102. Western spot at $84. That's an $18 premium. $18. When Western paper dumps and Eastern premium expands, it means physical demand in Asia didn't blink. Buyers in Shanghai didn't look at COMEX crashing and decide to lower their bids. The premium widened. That tells you where conviction sits. Not in New York, in Shanghai. Now let's talk about why gold and silver split. Gold holding above $5,300. Silver dumped from $97 to $82. There are two reasons. Textbook first. This is a supply shock event, not a demand boom. Supply disruptions create growth scares. When growth fears dominate, industrial metals get hit. Silver carries 50 to 60% of its demand from industrial applications. Solar, EVs, electronics, AI infrastructure, defense. When energy infrastructure gets hit and markets price in industrial slowdown, Silver's demand story takes the hit. Gold doesn't have that problem. Gold is purely monetary. No factory needs it. In this regime, gold leads, silver lags. The order is always gold first, then silver, then platinum, then copper. The more industrial the metal, the harder it struggles until growth uncertainty clears. That part is textbook and expected, given what's happening in the Middle East. But a $13 drop in 36 hours concentrated around New York trading hours? That's not just textbook macro. That has fingerprints. Maximum bullish sentiment after Friday's close at $93. Gap to $97 Monday. Immediate reversal before full market participation. That's a designed flush to shake out late entries, reset retail conviction, and position smart money lower before the next leg. Now, zoom out to what's actually driving the chaos. Iran struck 15 different countries or military installations. Israel, United States, UAE, Saudi Arabia, Qatar, Kuwait, Jordan, Iraq, Bahrain, Oman, Syria, Cyprus, plus French, Italian, and British positions. This is a multi-front engagement targeting energy infrastructure. Saudi Arabia's Ras Tanura refinery, processing 550,000 barrels per day, shut down after Iranian drone strike. Qatar halted LNG production. Qatar accounts for 18 to 20% of global liquefied natural gas supply. Gone. European natural gas prices exploded 47% in a single day. Largest one-day increase since Russia invaded Ukraine in 2022. Kuwaiti air defenses shot down 3 U.S. F-15 fighter jets. U.S. canceled 41% of Middle East flights. Trump said publicly, "We haven't even started. The big one is coming soon." 30% of global oil supply is offline or frozen. And oil is going down. Oil gapped to $82 and faded to $70. Someone is suppressing paper markets, despite physical reality screaming the opposite direction. We're seeing it in oil. We're seeing it in silver. The gap between paper and physical is widening, and history says that gap always closes. Paper doesn't win. Physical drags paper eventually. The question is timing and how much pain retail absorbs before it resolves. Now let's talk about what's happening in the physical market, because this is where the real story lives. China had a physical gold buying stampede Monday that crashed its largest e-commerce platform. Jingdong Finance couldn't handle the volume. Users unable to log in, unable to purchase. China holds 336 trillion yuan in savings. A slice tried to move into gold simultaneously. The infrastructure buckled. Every Chinese bank reporting gold rush. Every Chinese gold miner hit the daily limit up. Physical retail stores across China stopped selling investment gold bars. Sold out. The only gold available is craft gold at the equivalent of $6,329 per ounce. Western spot at $5,346. That's a $983 premium because there's no inventory. Chinese miners limit up. Western miners not following. Historically, miners amplify metal moves by 3 to 5 times. That divergence is either an opportunity about to resolve violently or institutional money telling you they're not convinced yet. Now, the resistance case. Because honesty matters when real money is at stake. Silver dropped from $97 to $82 in 36 hours. That's a 15.5% break. That's not minor. That's significant technical damage. FX Leaders notes, if silver loses the $82 to $85 zone, there's limited support until $75, possibly $71. COMEX futures at $82, while spot sits at $84. Backwardation usually signals physical tightness. But BN Crypto notes open interest on silver futures has been declining since February 6th, even as price rose from $63 to $82. Rising price with falling open interest is the signature of a short covering rally. Shorts buying back positions, not fresh money entering. Short covering rallies have a ceiling. Once covering exhausts, price needs new buyers to sustain. We may not be there yet. Western mining stocks not following Chinese miners could be institutional money signaling they're not fully committed. If you're using leverage here, these risks aren't footnotes. They're your primary framework. But here's what didn't change. China's platform crashed from physical gold demand. Investment bars sold out nationwide. Shanghai premium on silver expanded to $18 through the Western dump. Physical gold trading $1,000 above Western spot because nothing's available. Qatar LNG offline. Saudi refinery shut. 30% of oil supply frozen. Paper suppressing it all. Silver Institute projects 67 million ounce deficit in 2026. JP Morgan sees $81 average with 245 million ounce physical deficit. 6 consecutive years of deficit. China export restrictions affecting 60 to 70% of refined silver. COMEX registered inventories down 70% since 2020. Lease rates at 8%. The unresolved question sitting over everything. Does institutional money know something that hasn't appeared in public data yet? Paper suppressing physical reality across oil, silver, and gold simultaneously during the largest energy infrastructure attack in modern history. Those things happening at the same time in the same direction with the same mechanisms isn't random. It's coordinated. And the gap between paper suppression and physical scarcity has a historical resolution rate of 100%. It always closes. Paper always loses to physical. Every single time. The only variable is when and how much pain gets inflicted on retail holding leveraged positions before it resolves. So here's where we are. Silver is at $82 after gapping to $97 on Monday. It lost $15 in 2 days while war is escalating, Chinese demand is hitting records, and oil infrastructure is collapsing. CME margin hikes forced liquidations. Jane Street is sitting on a $1.3 billion position, extracting profit from the volatility. But the Shanghai premium expanded to $18 through the entire Western dump. Physical demand didn't budge. China's gold-buying stampede crashed their platforms. Investment bars are sold out. There's a $1,000 premium on the only gold left because inventory is gone. Paper markets are suppressing physical reality right now, but the gap keeps getting wider. And history is clear on how this ends. Paper loses. Physical wins. It's just a question of when. Stay sharp, verify everything you hear, and I'll see you in the next one.